Welcome to the Meadows Enterprises investor presentation. The goal of this talk is to give you an overview of the types of real estate activities we're involved in and to present you with an investment opportunity that we hope that you will find compelling for any idle capital that you may have laying around that could be earning a substantially better rate of return. A little bit about us. Meadows Enterprises is a Florida S corporation formed in 2013, and it is the real estate investment vehicle for the Meadows family. We participate in a broad spectrum of residential debt and equity offerings, ranging anywhere from providing short-term mortgages on single-family houses to fractional ownership of larger multifamily apartments and a whole host of other things in between, such as real estate crowdfunding. My name is Kenyon Meadows, and I serve as the president of the company. I'm a board-certified radiation oncologist practicing at Southeast Georgia Health System in Brunswick, Georgia. Meadows Enterprises was born out of my desire to learn about investment alternatives other than traditional paper assets that we all might be familiar with, such as stocks and bonds. Walita Meadows, my lovely wife, serves as vice president, and she has a background in both business administration and real estate. She's worked in a number of capacities in the real estate space, including as a licensed agent, and as well as working for the largest real estate property management firm in Jacksonville, Florida, which is a key market for us. To speak a little bit about the value proposition of this investment, I'm going to make some assumptions that you had some similar problems to ones that I had a couple of years ago. Number one, do you have significant amounts of idle capital sitting in a savings account or money market account, essentially earning no real return? On the left-hand side of the screen is a snapshot of some of the one-year CD certificates of deposit rates of return offered by some mainstream banks, such as Sallie Mae and Barclays there, as you can see. And the rates are quite low, ranging from 0.8 to 1.2%. When you consider that a lot of economists say that the real rate of inflation in this country is more on the order of 3 to 4%, you can see that parking your money in one of these accounts long term is really a recipe for purchasing power and wealth erosion. So it follows that you would want to be invested in something that's at least earning 4% rate of return just to keep even with inflation. On the upper right-hand portion of the slide is the famous cash flow quadrant made popular by real estate investor Robert Kiyosaki. And regardless of where you may be on the cash flow spectrum, and indeed many of us are in multiple quadrants, Kiyosaki and other financial luminaries all implore us to try to get as much into the investor quadrant as possible, where you have money actively working for you, and therefore you can start to decrease the intensity in which you are in the other quadrants, which to some degree all have you trading your time for money. So besides being an investor, he also advocates being a certain type of investor, namely one that invests for present monthly cash flow. So while it's of course necessary to invest into our retirement accounts and other deferred type of situations, when we think about how we handle our day-to-day budgets and expenses, things tend to work on a monthly cycle. And so starting to have some of your money generate current new money that you can use to potentially pay current expenses is very gratifying. And now that we're starting to see some substantial amounts of money come in to the point where we can pay a utility bill or use some of that money to help pay for a vacation and not lean so heavily on my income from work, that has been very gratifying. So to talk about some of the specific activities we've been involved in, generally speaking, when you talk about real estate investing, you can talk about being involved on the real property side, such as owning a rental house, or alternatively being involved on the paper side, where you invest in mortgages, notes, deeds, and other debt instruments that generate a return for you in the form of interest payments. And that's principally what we've been involved in. To look at the top example of rehabilitating a house, I'm sure many of us can recall the popularity of the flip this house type of shows that were on television, particularly prior to the 2008 mortgage crisis. Well, banks have never been in the business of loaning money on houses that needed a substantial amount of rehab. And so there's always existed this private market for mortgages that were typically supplied by high net worth individuals such as doctors and dentists, small business owners, and they would supply the short-term capital for the rehabber to acquire the house, rehab it, and then sell it. Because there was anticipated a large amount of profit potential on the sale afterwards, the rehabber could afford to pay the mortgage provider rates on the order of 12 to 18% per year and still make a profit. Thus far, we've had 3 successful exits of projects such as this and have another couple in the works as well in and around the Jacksonville area. On the bottom example, rehabilitating a mortgage. This is an arena that is much less well known in the real estate investing space, but nonetheless can yield very attractive rates of return for the passive investor. So as we all know, banks have and continue to have several mortgages on their books that are essentially underwater, and the homeowner's equity has been wiped out, and a lot of these homes have gone into or will soon go into foreclosure. Well, the federal government had encouraged the banks to work with the homeowners in the form of writing down some of their debts and restructuring the mortgage payments so that it would be something more reasonable for the homeowner and to keep them out of the foreclosure process. Traditional banks do not have the infrastructure, personnel, or even inclination to do this time-intense work on an individual homeowner basis. So for them, it would make more sense to just simply sell off or get rid of these bad mortgages off their books. The kicker is they will only sell these mortgages, often for pennies on the dollar in terms of how much is owed, if you can come in and buy large chunks of their mortgage book, $50, $100 million at a time. So what has happened is that there are specialty private equity firms that will solicit money from investors such as myself, build up a fund, and buy these mortgages in bulk off of the bank. And then they will in turn do the tedious work of contacting the individual homeowner and reworking their mortgages, including writing off debts and restructuring things to bring them out of foreclosure, and still be able to pay the passive investor, such as Meadows Enterprises, 10 to 14%, but because they again acquired the mortgages so inexpensively from the bank, there's still profit margin for the private equity firm. So while we've been quite pleased with the returns on the paper side, we do recognize the need to own some real property long term to build lasting wealth. And so we have decided to slowly build a rental portfolio. In June of 2014, we acquired our first single-family rental home. We chose to focus on the working class neighborhoods on the west side of Jacksonville that were 3-bedroom, 2-bathroom homes with a minimum size of 1,200 square feet. The purchase price was $75,000 and the rent is $1,000. When you talk about investing in single family real estate for cash flow specifically, a good rule of thumb to keep in mind is what is referred to as the 1% rule. This rule basically states that you need to get at least 1% of the purchase price as rent on a monthly basis in order to reliably cover the expenses associated with the property, such as mortgage payments and the like, in order to hopefully at least break even, but more favorably be cash flow positive. So the rule is used for quick estimation, but I found that when you actually look at some of the detailed numbers in terms of expenses that are typically associated with a property, if you can conform to this 1% rule, it generally does make for a sound investment that can produce positive cash flow. What about properties that don't conform to the 1% rule? Looking at properties at the extremes of the market, both in terms of being very expensive and very cheap, is illustrative of why we've chose to focus where we have in the middle part of the market. As a general rule, you don't see very expensive homes being rented out. And the reason is because even though they would command generous rents, say $2,000, $3,000 or even higher, oftentimes for the purchase price, that rental amount is much, much less than the 1% rule. And so you would be facing often a negative cash flow situation. Additionally, there is a relatively small renter pool of people who are able and willing to pay rents in that range. So if you have an expensive house, really you're counting on appreciation over time and eventually selling that house to really make money on it as opposed to renting it out as a general rule. When we look at the other end of the spectrum, very cheap homes, say a home that might have a purchase price of $25,000 or $30,000 and maybe rent for $600 to $800 a month, well, in that situation, you're very much ahead of the 1% rule and oftentimes can get returns on the 2 to 3% cash flow per month. Now, because these homes are often in not great areas, there is very limited appreciation potential. But again, if cash flow is your aim, they certainly can cash flow. The big issue with them is that there tend to be a lot of tenant and or deferred maintenance type of issues. And so these can be very time-intense homes in terms of turnover of tenant, poor upkeep of the property on the tenant's issues, and episodic major repair expenses that will eat into that cash flow. So what I'm proposing for the outside investors is that they contribute money to help us find more of these houses in what we call the middle sweet spot of the market. Homes that generate between a 1 to 1.5% monthly cash flow. They'll be moderately priced, and therefore there'll be a large renter pool. And for the type of rents that we are looking for, they are very manageable with the typical median household income of $55,000. And so we want these to be 3-bedroom, 2-bathroom, single-family homes. Again, the minimum space requirement of 1,200 square feet. The statistics will say that these are the homes that are rented out in the largest volume, and that the tenants tend to stay in place for the longest time too, minimizing turnover. So to take a look at some of the numbers based off of our first rental property on Sailmaker Lane, To take just the acquisition price and the monthly rent, you see that translates into a 1.33% monthly rate of return. So certainly conforming to our 1% rule. And looking at some of the expenses, and these are actual numbers or very, very close approximations, and with property taxes, insurance, maintenance, and property management, subtracting that all out, that leaves us with a net income of approximately $9,047, and divided by the purchase price, that translates to a net return of 12.1%. That does not take into account our ability to write off some of these expenses, and it does not take into account the allowable depreciation on the property. So when it's all said and done, we're looking at a return more on the range of 14% per year. So how would the loan be structured? I'm sorry, how would the investment be structured? Well, it'd be structured in the form of a loan. You would receive a formal promissory note, which is a legal obligation to pay. The length of the loan would be 1 year, so relatively short, and we're asking for a $10,000 minimum investment. For that, you would be entitled to an 8.5% annual interest rate that would be paid out as a monthly interest-only payment. And as an added measure of comfort and security, we actually are going to offer full liquidity of your initial capital after 90 days. So if for whatever reason the investment is doing well, performing as expected, but you have a situation where you need your money back, you just let us know after the 90-day holding period, and we would write you out a check for your initial capital in like a week. Another measure of security for your investment would be a personal guarantee document. So this would basically be a pledge of my own personal assets as a second line of collateral for your money. And that would principally be my W-2 income that I own as a physician. And the other thing to keep in mind too is that we are ultimately purchasing a real asset that will be debt-free with this rental house. There'll be no other bank debt or anything like that. So even the house itself could be sold as a way to pay you back if needed. So in summary, we are seeking debt capital to expand our business, specifically in the area of adding more rental property to our portfolio. I think for the type of homes that we're looking for, this represents a very conservative risk profile. These should be homes that should be in high demand to be rented by families at moderate prices. And I'm pleased to announce that we have had commitments to date of $40,000. So if this interests you, again, the main purpose of this presentation is to generate a conversation. I would hope that you would give me a call or an email so we could talk about things in more detail. And if you got comfortable, we would send out the necessary documents for you to execute and go from there and hopefully make money together. I appreciate your time and look forward to hearing from you.